The American banking system is one of the most complex and influential in the world, playing a crucial role in both the domestic economy and the global financial landscape. It consists of a diverse network of institutions, including commercial banks, savings and loan associations, credit unions, and investment banks. These institutions are responsible for safeguarding deposits, providing loans, facilitating payments, and supporting the broader economy through credit creation. Understanding this system is essential for anyone interested in finance, economics, or the policies that drive the U.S. economy. The roots of the U.S. banking system trace back to the late 18th century, shortly after the founding of the nation. The first Bank of the United States, established in 1791, was created to stabilize the young economy, manage government debt, and provide a uniform currency. Over the next century, the banking landscape evolved through the creation of the Second Bank of the United States, the National Banking Act of 1863, and the establishment of a dual banking system that allowed both state-chartered and federally chartered banks to operate. The modern American banking system is anchored by the Federal Reserve, established in 1913 as the nation's central bank. The Fed oversees monetary policy, regulates financial institutions, and provides financial services to the government and commercial banks. It controls interest rates and the money supply to stabilize prices, manage inflation, and support economic growth. Its decisions have profound effects on both the U.S. economy and international financial markets. The U.S. banking system is highly regulated to maintain stability and protect consumers. Major regulatory bodies include the Federal Reserve, the Office of the Comptroller of the Currency (OCC), the Federal Deposit Insurance Corporation (FDIC), and the Consumer Financial Protection Bureau (CFPB). These agencies ensure that banks operate safely, comply with laws, and manage risk effectively, particularly after crises such as the 2008 financial meltdown. One of the hallmarks of the American banking system is the FDIC, which ensures deposits up to $250,000 per depositor per institution. This protection enhances public confidence in the banking system and prevents bank runs, which were common during the Great Depression. Consumer protection laws also regulate fees, interest rates, and transparency, ensuring that Americans can make informed financial decisions. American banks offer a wide range of services to meet the financial needs of individuals, businesses, and governments. These services include checking and savings accounts, mortgages, personal loans, credit cards, business financing, and investment advisory. Modern banking has also embraced digital technology, offering online and mobile banking platforms that allow users to manage finances efficiently and securely. Banks are the backbone of the U.S. economy, providing the credit and liquidity necessary for growth. By lending to consumers and businesses, banks support spending, investment, and job creation. They also help channel savings into productive investments, acting as intermediaries between depositors and borrowers. The health of the banking sector is therefore closely linked to the overall economic performance of the country. The Federal Reserve uses commercial banks as a key instrument for implementing monetary policy. Through tools such as the federal funds rate, reserve requirements, and open market operations, the Fed influences lending, borrowing, and spending behaviors. Commercial banks, in turn, respond by adjusting loan interest rates, which affects everything from home mortgages to business expansion decisions. The American banking system faces numerous challenges, including cybersecurity threats, regulatory compliance, and the emergence of fintech companies. Technological disruption has forced traditional banks to innovate and adopt digital platforms to remain competitive. Additionally, economic fluctuations, such as inflation or recessions, can strain bank profitability and stability. Historically, crises like the Great Depression of the 1930s and the 2008 financial crisis have shaped the banking landscape. These events exposed vulnerabilities, leading to stricter regulations, the creation of deposit insurance, and the development of crisis management mechanisms. They highlight the importance of oversight, transparency, and responsible lending practices in maintaining financial stability. In recent years, American banks have embraced innovation, incorporating artificial intelligence, blockchain, and mobile payment systems to improve efficiency and customer experience. Fintech startups have introduced peer-to-peer lending, digital wallets, and cryptocurrency platforms, challenging traditional banking models. Banks now focus on integrating technology while maintaining regulatory compliance and security. The American banking system remains a dynamic and essential component of the national and global economy. It has evolved from small local banks to a sophisticated network of financial institutions that support innovation, investment, and growth. Looking ahead, challenges such as technological disruption, economic uncertainty, and global competition will shape its future. However, with continued regulation, innovation, and consumer trust, the U.S. banking system is likely to remain resilient and influential for decades to come. A distinctive feature of the United States is its dual banking system, which allows banks to be chartered either by individual states or by the federal government. State-chartered banks are regulated by their respective state banking departments, while nationally chartered banks fall under the oversight of the Office of the Comptroller of the Currency. This framework encourages competition and innovation, as states often experiment with new banking rules, yet it also demands careful coordination to avoid regulatory gaps. The coexistence of these two levels of authority reflects America's broader federal structure, balancing state autonomy with national standards. Beyond the towering skyscrapers of Wall Street, thousands of community banks quietly support small businesses and households across the country. These locally focused institutions often have deep relationships with the neighborhoods they serve, offering personalized lending for farms, family-owned shops, and first-time homeowners. Community banks are critical for rural and small-town economies where large national banks have little presence. Despite consolidation pressures and rising compliance costs, their role in maintaining financial inclusion and regional development remains irreplaceable. American banks are not only domestic players, they are also global powerhouses. Major institutions such as Permigan Chase, Citigroup, and Bank of America operate extensive networks abroad, facilitating international trade, currency exchange, and cross-border investments. The dominance of the U.S. dollar as the world's reserve currency further amplifies their reach, making U.S. banking policy influential in foreign markets. Decisions made in New York or Washington can ripple across Europe, Asia, and emerging economies, demonstrating how tightly the American banking system is woven into the fabric of global finance. While traditional banks once viewed financial technology startups as rivals, many now pursue strategic partnerships to stay ahead. Collaborations with fintech firms enable banks to integrate services such as instant peer-to-peer payments, robo-advisory investing, and advanced fraud detection using machine learning. These alliances help legacy institutions modernize without abandoning their regulatory obligations. At the same time, they blur the line between banks and tech companies, prompting regulators to rethink rules around data privacy, cybersecurity, and consumer protection. In recent years, banks have faced mounting pressure to address environmental, social, and governance concerns. Investors and advocacy groups urge financial institutions to reduce financing of fossil fuels, improve diversity in leadership, and adopt stronger ethical standards. Many large banks have announced net zero carbon targets and expanded lending to renewable energy projects. Balancing profit motives with sustainability goals is challenging, but the push for ESG accountability is reshaping lending priorities and influencing how banks evaluate long-term risk. Finally, the effectiveness of the banking system depends on the financial literacy of its customers. Without a clear understanding of credit, interest rates, and investment options, consumers are vulnerable to debt traps and predatory practices. Banks, nonprofits, and government agencies have launched programs to teach budgeting, saving, and responsible borrowing, particularly for young adults and underserved communities. By fostering financial education, the American banking system not only protects consumers but also builds a stronger foundation for sustainable economic growth.